You're listening to the Millennial's Choice Show, Canada's most trusted podcast on all things real estate, finance, and entrepreneurship. Here's your host, Matthew Ablacan.
What's going on, Choicers? Welcome to another episode of the Millennial's Choice Show. I'm your host, Matthew. It's really good to be here with you guys today. I'm blessed. It's another day. I'm in the studio with my main man, Day One Carson, and I've got special guest in the house, Kiri, today. Kiri, I'm not going to try to butcher your last name. Can you say it?
Of course. Kiri Parmesan. It's like Parmesan.
Like Parmesan. I like that. So Kiri is a mortgage advisor, mortgage specialist with one of the big six banks. He's personally assisted me in arranging my own mortgage as well as mortgages for my clients. And so I really wanted to bring someone from the bank's perspective to the show because typically we kind of talk about all these changes that are taking place. Danny and I talk about it. We're licensed, but we have a little bit more leeway in what we could say, what we can't say, but we also only have a broker's perspective. So obviously we want to hear from the bank. There's been, inflation's at 2%, rates are on a decline, bonds are getting smacked, different mortgage qualification rules are being passed. And we want to get into all of that from your perspective, being with one of the big six banks. So welcome to the show.
Thanks for having me here, Matt. Appreciate it, and appreciate all the love we've been getting from Millennial's Choice group of companies.
We love to give love. That's what we do. Love people. We love people. So let me get right into it. We typically hear if we talk about the inflation numbers first. So like we hear about it like everybody else. It's usually in an article or something, and it gets a lot of traction. And then all of a sudden, every realtor, every mortgage specialist, all over social media.
Instagram.
Yeah, that's it. Instagram. Inflation's at 2%, inflation's at 2%. So like, what does that look like for you when you, as a person who works at the bank, you wake up, are you getting notifications from the bank? Are you hearing something internally? Like, how does that go?
So we don't necessarily get notifications right away from the bank itself. But once the announcement's completed, we'll get you can subscribe to it too, even your viewers. CIBC Capital Markets has an economic article that they release that you can release and review the numbers on that.
Okay.
So that's how I usually find out about it, or I monitor everything myself as well.
Nice.
Online.
So there's no real inside scoop that people at the bank know about, or at least maybe the tip tops, we don't know. But
exactly. Not at our level, right? Client facing, more I guess shot calling levels. People will find out beforehand, right?
Got you.
Yeah.
Okay, so let's play out the scenario. Inflation's at 2%. We had a very slow summer when it comes to real estate and mortgages, extremely slow. The last 2.5 years have been very, very hectic. And, the entire industry took a beating, basically. Now inflation's low. Rates are on a decline. What does that look like? Now you walk into the branch or you're working with your colleagues. What's the sentiment like?
It's positive, right? Everyone's ready to work. They're looking forward to seeing how the market plays out in the next, winter market that's coming up, and also leading into spring 2025. I think in my personal opinion, there's going to be a lot of activity in spring 2025, especially with renewals coming up from 2020, people that bought in COVID. So everything's going to come about around that time period. And depending on the announcement in October, I feel like that's going to have a huge play in how the market plays out in the next, 6 months, right?
Yeah, I agree, because as I was saying, even in one of our other episodes, August was slow. Inflation number comes out in September, 2%, but it's naturally slow.
By the way,
yeah,
2% inflation rate is what they're saying to us. But if you take out the mortgage interest rates out of the equation, or mortgage payments, actual inflation is about 1.2%.
Yeah. So for you guys listening to that, what that means is part of the calculation in getting to that 2% figure is actually mortgage payments. And what happened with mortgage payments over the last 2.5 years, typically they went up. Unless you were in a fixed rate and you didn't get touched, they went up. And that factors in on the inflation. So it's kind of very backwards in a sense, because they were trying to get to this 2% target while raising rates, but at the same time, raising the rates caused inflation to go up in one area of that calculation. And so now what Kiri is saying, we're at 2%, but rates are still high compared to what they were back in 2020 and 2021. And that means if you were to factor that in, inflation should actually be less than 2%. Okay, so less than 2%, does that mean that maybe we're not going to see as much rate cuts that the bank is talking about? Because then if they cut the rates down and the mortgage payments go down, then technically they'll be below that 2%. Correct. And they'll say, why should we lower the rates? We're already below our target.
I think what they might be doing is what they did in the beginning when they started increasing rates. They front loaded the increase, meaning in July 2022, I believe, they increased it by almost 1%. So rather than gradually increasing it, they went heavy on one side. So I feel like they might just do the same thing on this way, decrease the rate, by 50 basis points or so. That way it's already decreased enough where they don't have to do a gradual decrease over like the next 6 months, announcements, right?
So they might do 50, then 0,
and then
25, whatever.
And then keep it the same. That way, like typically monetary policy changes will come into effect. We feel the impact of it like 8 to 12 months after.
There's always a lag.
There's always a lag, right? So that's what I'm saying. If they decrease by 50 basis points, I feel like by next summer or spring, we're going to feel the actual activity in the real estate market.
It's interesting because the other school of thought is that we're in a recession.
Yep.
We're headed towards one. Either we're in it, we're headed towards one. And the fact that our US counterpart is cutting by 50 basis points, the fact that we started cutting earlier first and we're signaling that there's going to be more cuts, in fact, is actually just signaling that we're not in a good position.
No.
So there's that school of thought too.
Of course.
So, because if we hit the 2% target, then why do we need to cut? If you think about it.
It's true.
Especially knowing that the more cuts there is, then that segment of the calculation is going to result in further the inflation rate going down. I don't know. It's going to be very interesting to see how it plays out.
And to find out, we just have to buckle our seatbelts in, right? Go for the ride.
Definitely. We're all in on the ride. That's for sure.
Exactly. Especially with the US decreasing rates by 50 basis points a couple of days ago. They're in a better position than us, right? Economic wise, like economy wise, their production levels are much higher.
Yeah.
We're at much lower levels compared to a lot of G7 countries as well.
Yeah.
So in terms of our situation, I think it's going to be very dependent on how the US plays out.
Yeah. I mean, it's like there's that saying that when the US gets a cold, we sneeze or something like that. Exactly. If they sneeze, we get a cold, something like that. So it'll be interesting because the fundamentals are completely different.
Yeah.
But at the same time, they're one of our largest trade partners. And,
exactly.
They're our neighbors, right? So we'll see how it plays out. So what do you, back to the sentiment of when you're seeing these numbers come in, is the bank saying, you know what, we got to get aggressive now. Now's the time to get aggressive, lock people in at these rates before they keep going down. Are there any talk? Like, what are those talks?
There's no topics like that. Like when we're helping clients, I want to know how risk averse they are, right? So I can guide them according to what rates they should be looking at. If a client that's coming first time home buyer, tight budget, you might not want to go on a variable. You might want something that's more peace of mind, right? Someone that doesn't want to worry about the rates coming up all of a sudden, maybe go on a 5-year fixed. Even a longer term, if we did offer it, US offers 15 years, 25 years.
Yeah.
Right. But in terms of sentiment from us as an advisor, it's our responsibility to find out exactly what the client's looking for.
Right. So at your level, they're not having those conversations. No. But you could kind of see that some banks are getting more aggressive than others.
Of course.
Yeah. Why do you think that is though?
I think it's closer to year end for the bank's fiscal period coming end of October. They might want to get more market share. Right? So dropping rates, it's a rate war out there right now between the top 5 banks. It's a rate war. So I think that all comes down to the bottom line, trying to make their, books look good towards the end of the year and gather much as market share as possible towards the new fiscal year.
So that's to also directly impact their share prices?
Yeah, at the end of the day, it doesn't directly impact it, but it goes to the balance sheet. So somewhat.
Right. So what are we looking at right now in terms of a 3 or a 5-year fixed rate? Best case scenario.
Best case scenario, you'll be looking in close, like some banks are offering just under 4% on a 3-year fixed.
They're already offering that?
Yeah. Some banks are offering on a 5-year about 4.19 you can get.
Wow. Okay. So we're already there.
Yeah.
So you're already starting to see threes.
High threes.
High threes.
Yep.
Wow. So in another episode, we were talking about in a few weeks that's where I think we're going to be. So
that's because bond yields also took a massive hit over the last 3-4 weeks
yeah.
in the market. So that's impacted it as well. But
So bonds directly impact fixed rates.
Correct.
And Bank of Canada announcements directly impacts the variable.
correct. Anytime the bond yields go up, rates will go up. Bond yields come down, rates come down.
Right. Because it just becomes more attractive for investors to either invest in a
Borrow,
bond or
yeah.
invest in the mortgage.
Exactly.
Because
To
we're
borrow
talking
or
large.
invest.
Yeah, we're
Yeah.
talking large institutional
Exactly.
investors. So you're already starting to see in the threes. Where do you think, from your experience, we're going to be towards the end of 2024?
Fixed rates wise,
Yeah.
I think we'll be high threes.
Still high threes
Yeah. Like low fours to high threes right now.
right now. And then so you think probably we'll see like what, 3.7,
3.8,
3.8?
3.9, yeah.
Yeah. You'll think it'll kind of level out a little bit.
Exactly. But I feel like after a few more weeks, the banks might start going back to offering regular, as not as competitive as aggressive rates.
Because then we're at the start of coming up to a start of a new year.
Fiscal period, yeah.
Interesting.
From my experience, like towards this time of the year, typically fall, winter time, rates are typically lower in the markets.
Because there's less activity
Less
for them?
activity,
Less
trying to
volume?
Exactly, and like trying to get more clients coming to the door, get more mortgage originations completed. So toward this time of the year, I feel like rates will be somewhat lower.
Okay. So there's been this thing where a lot of banks are not really enforcing power of sale, and they're working with the borrowers and they're trying their best to like help them out. Is that true?
It is, because end of the day, it's not the bank's first choice to kick the borrowers out or the owners of the home out. End of the day, it's bad look. It's a bad look for the bank. It's a reputational risk for the bank as well. They don't want to do that. They typically they'll work with them for like 90 days, 4 months to see how much, if they can pay up or bring the mortgage up to date. After that is when the whole process gets kicked in. And it's not like we hear about in the news or talking to people where it's like within a snap of a finger, it's done. There's a
Right.
whole legal process that needs to be done. They bring in the legal team, consult with the legal team. Even if I was to give you a power of sale, Matt, it's not what you think where you can just take the listing and go put it up.
Right.
You got to talk to the lawyer that's involved, get their input. You got to give them CMAs, review everything, and then put the property on sale.
Right. Yeah,
Right?
absolutely. Well, because whatever they sell the property for, after fees and expenses are paid, the rest of the equity does go back to the owner, which is the borrower in that case. So it has to be done in a fair and transparent process.
Exactly.
Yeah. I actually bought this unit that we're in as a power of sale.
Oh, yeah?
Yeah.
Nice. How long ago?
I bought it April of 2020 when COVID was like super mainstream already,
Yeah.
and the prices came down for commercial real estate. Yeah. So it
Beautiful.
was a power of sale.
Nice.
Yeah, a bunch of private lenders that were involved in this deal. I don't know who the owner was, and like there was like 3 private lenders on it.
3 separate lenders?
Yeah, for like he bought it for 600,000. We bought it for like 440. So it was a good deal.
Good deal.
It was a
Yeah.
good deal.
That's
We
good.
did good.
Good
Yeah.
area too.
Yeah, very happy.
Was the
with it.
condo already fully, like everyone moved in already at the
Yeah.
time, or?
Yeah, they did.
Nice.
Yeah. Okay, so there's obviously people at the bank that are in hot water that the bank is working with.
Mm-hmm.
Have you personally experienced people giving you a call and saying, "Kiri, I need help"?
Not now. I haven't had anyone directly defaulting on payments. I've had people that I've spoken to that are on like variable and their payments are not making sense. I've had to guide them on what to do or how to bring them up to date.
Right.
But I've never had anyone really default
Okay.
on the payment wise.
Yeah, I was asked a similar question.
Yeah.
We closed from pre-construction real estate. We closed 26 to 30 units this year, just from old buildings that lagged and now they
Yeah.
closed. We didn't have any issues. Like no one's called me and said like not any of my clients have called me and said we need help.
Yeah.
So, I mean, that does speak to like how we qualify at the very beginning. Like before we start purchasing anything, looking at anything, you need to be qualified.
Also, my opinion too, I think a lot of people don't like the stress test, but us qualifying those clients before when they got the mortgage approvals on the stress test kind of helped when the rates went up in 2022, right?
Carson mentioned that in our other episode. And because that's the idea of the stress test.
Exactly.
I think where people got caught off guard is that when you're using it for qualifying purposes, that's one thing. But then people don't actually realize what their payment will be at 5.5% or 6%.
Exactly.
Because it did go up higher than what the qualifying rate of 5.45, I think, was at the time.
Yeah.
So if someone is at 6.5 or 6, it's over. But at the same time, the advisor never really shows the payment.
Exactly.
You're just using it to qualify because you have to, but you never go to the client and say, if the rate does go up to this is what your payment is.
Correct.
It's rare that any broker or any mortgage advisor has that conversation with the borrower.
It's a hard conversation to have with the borrower to make them understand the policies we follow, but typically we should be doing that. I do it when I'm speaking to clients. I ask them, what's your plan if your income is reduced or something happens to you, like knock on wood.
Yeah.
What are you going to do to help you cover the payments, right?
Yeah.
So I think that type of conversation helps you navigate that whole scenario.
I guess the qualifying rate from a material risk that the lender has exposure-wise is good.
Exactly.
Because then they know, okay, this is what our book of business looks like if rates are at 6%.
Yeah, exactly.
And if we're being honest, the last 2.5 years, the banks have made a shit ton of money.
No comment.
A shit ton of money. Pardon my language, but it's, I have this little survey card, and one of the questions I ask when we're at an event to consumers, everyday people, I just say, how much have you been impacted by rising rates? On a scale of 1 to 10, 1 being positive, 10 being negative, and anywhere in between. And people will look at it and go, who was affected positively?
Yeah.
I'm like, banks, B lenders, private lenders. They've been making a killing.
So let me ask you one question though, okay?
Yeah.
So as a consumer in 2020, 2021, of course, borrowing was very low. Cost to borrow was close to almost 1% sometimes on a variable. So people leveraging that as an opportunity to buy not one, 2, 3, 4 houses, getting HELOCs, home equity lines of credits on their properties to do that. At the time, they were able to manage those monthly payments. But once the rates went up, everyone started panicking.
Yeah.
Right. So I feel like that was a oversight. But how could they have managed that?
Yeah. So, I mean, we had somebody who came to us around that time and said, I have $300,000 and first time home buyer, and I want to invest it, and I want to buy 2 condos. And I knew what he did for work and all that stuff. And I said, you know what? It's better you just buy one. And then that's what he did. He bought one, more than doable. Down payment was $120. He has all this money left over. I felt comfortable putting him in that deal. And then he goes to close the deal and he's in trouble. And I go, where's the rest of the money? Oh, I lost it. And it's like, what'd you do? Right. And he did apparently what he told me, he did some crypto investment. And, to your point, people that bought those properties should not have bought those properties. And realtors do a bad job at this because it's all about commission for them. And so they don't properly advise. And in our industry, we don't have like a needs-based approach. In life insurance, for example, you can't just give a certain life insurance policy to the person. There needs to be what's called a needs analysis done.
Of course.
And I think that's going to come eventually in real estate and mortgages. People do it already.
KYC, you need to do
know
that.
your client, right?
Yeah.
So that's how I operate my business. That's why I don't have these issues come up.
Exactly.
Because the people who buy, they're qualified. Now, have there been a couple people that really struggled since the variable went up to 6.5 or whatever it was? Of course. And the rents didn't go up and it's like their negative cash flow. Yes. But at the end of the day, you have to be prepared for that risk.
Exactly.
And if you're not, or you're not that you're not prepared, but you're not risk adverse, like you don't want to go through that, don't buy it. Because buying a property, signing on the dotted line, it's easy. Closing it, managing it, becoming a landlord is not easy. It's a business. You're buying into a business. And so it requires day-to-day management of that business, right? And so, yeah, I think that those people, how do you manage that? You should have never bought it. Should have never bought those properties. Should have bought one.
Exactly.
One and handle that. But when the times are good, everybody has an umbrella. And when the times are bad, they're not giving you an umbrella. So you have to be prepared for that, right? Don't over leverage yourself.
Exactly. And as advisors, like you said, I feel like it's our responsibility as well to let our clients know, like what they're doing, right?
We have to, because we have the license.
Yep.
We're in that position. They depend on us to guide them. And it's not just, people don't just call us and say, I want to buy this property, help me out. No, there's a process that's followed. Sometimes it takes years from the time someone talks to us and then the time they purchase, because they're just educating themselves and they're raising their awareness in terms of the process and how things work. And so I think that's a very important part. Like, I've always lived by that. First you learn, and then you remove the L, and then you earn. So it's like, you have to learn. You can't just say, because this realtor is saying this, I don't know, pre-construction property is going to make you money. How do they know? And it's not just that simple. There's who's the builder behind it? What are their plans for the area? What stage are you getting in at? Right? You need to know a lot of different things. Which floor plan is the most popular?
Exactly.
What units are getting absorbed quicker? Nobody uses that word. I've heard people in those sales offices, because I'm one of the top guys in that field, in that space. And I've heard people say, if you're not serious, don't talk to me if you don't have your checks. And it's more of like instilling that fear of missing out, which is not a good way to sell.
It's not.
For me, it's all about education. What is it you're trying to achieve? And then let's work backwards. That's how I do it.
You have to reverse engineer it.
Yeah. It's called the backwards approach in teacher's college. So I have my teaching degree, right? So I went to teacher's college. And when we were in high school, at the beginning of the year, they give you the CPT. Do you guys remember CPT? Culminative something task. I forget the P. It was basically at the start of the class, they give you what your final project's going to be.
Oh, I didn't have that in high school. I was in Peel. I don't know.
I don't know, man. We had a good school, so I don't know. But we basically, at the beginning of the year, they'd give us the project. They'd say, we're going to teach you whatever you need to learn to finish this project. So as you go on, you're going to learn what you need to learn so you could put this project together. And so that's called the backwards approach. And they'd give you the project and then give you the information you need later on to finish that project. And so that was my training, right? So I kind of go about it that way. Like, one of the first questions I ask is, what are you trying to do? I'm trying to buy the first home to live in. Okay. And then we go from there. I want to buy a rental property. Okay. So like, there's different
it's ingredients.
Yes.
Doing it, right?
Yeah. And so I like going about it from the backwards approach with the end in mind. Exactly. And how do we get there? Exactly. That's how I base it off of.
That's how we look at mortgage approvals too.
Yeah. Why would I tell someone to buy pre-construction real estate if they're looking to move into their home over the next 12 to 24 months, and knowing what I know about pre-construction real estate, that there's so much delays that by the time it's ready, a lot of people's plans change and then they don't even want to live there anymore. That might not be the best product for them.
Yeah.
You have to ask the questions to find out what the right product is. That's what I do.
I'm curious to know, with pre-construction projects right now, are you hearing about horror stories where people are signing deals for like less than 200,000 purchase price, things like that?
Yes.
Really?
I'm seeing it. I'm part of a bunch of groups on Facebook, and also internally off-market deals that come our way. And it's just people, again, that should have never bought, that do not want to close or cannot close. And there's fire sales. Right now is the time to pick one of those up if you want to, you want to have a little bit of a spread, because now I'm not seeing like AAA locations and like AAA types of products. It's more condos, or I'm seeing low-rise homes in like Whitby, or like, honestly, some cities I've never even heard of, like
really?
Some like rural cities. Like, I'm not seeing that happen so much in Vaughan, right? But I'm seeing that, and it doesn't make sense to me. So I'll give you an example. You know about the condo I had in Thornhill earlier this year? Buddy, if I gave it away like for what I paid, nobody wanted it. So I closed it. I paid an extra $25K to close. Total, I paid about $40K in closing costs. I listed it on the market. I paid $18,000 and change for commission for a buyer agent. And then after it was all said and done, I still walked away with a profit after all that of $30,000.
Wow.
But I couldn't give it away for what I bought it for. So sometimes I question that. Why? Why is it that way? And from the very beginning of my career 12 years ago, I realized very quickly a lot of agents don't like dealing with assignments. They're not comfortable with assignments.
Why? Is it the way the deal is structured, or is it the comp?
No, it's because realtors suck at math. There's a section in that offer that requires you to do some number crunching, and it's super easy to do. And I feel like they get scared of that, and so they shy away. I've done deals for agents where I've been the listing agent and I have assignments where I just give them the schedule. And I go, can I just, so we just avoid all the crossing out and all the initials and fixing it because there's a lot of numbers. Can I just calculate that for you? And we do it.
You give it to them?
Yeah, I get, because it just makes my job
of course
easier, and it helps me to help my client out. So a lot of people are scared of just assignments. So assignments are not a good indicator of, the inventory, because it'll just sit on the market and linger.
Of course.
There's a few people that actually engage with assignments. Some agents just don't know. Mm-hmm. And my case in point was that Thornhill condo. As soon as I closed it, I couldn't give it away for $980 a square foot. I sold it for $1,115 a square foot. What does that tell you? Also, with assignments, you don't usually see the unit. So it's like you're buying pre-construction, but it's going to be ready in 60 days and you don't see it. So it's one thing to buy off paper, and it's one thing to see it. So unless you're taking a massive hit and you want to walk away from a deal and open yourself up to potential lawsuits from developers and things like that, my suggestion is always close it as an investment, flip it, take your loss at that time, but at least you can flip it quicker. And that loss is going to stay, if it's an investment property, is going to stay on your record as a capital loss credit on your CRA file. If you're going to keep investing in the future and there's capital gains, you can
use it
dollar for dollar,
right?
offset it. Yeah. That's my strategy.
Of course.
Yeah, like if that ever happens, that's what I do. Build up a bunch of tax credits. I'm still going to invest in the future. Mm-hmm. Yeah. The one time I lost $100,000 on a stock, dude, it was so
Was it cannabis stocks?
No, I wouldn't. No, I never invested in that. It was a medical stock. Not medicinal cannabis. No, it was for like COVID tests and things like that.
Yeah.
And long story short, I was so devastated.
It's heartbreaking, man.
Bro, it's so devastating. Like, it's so much, like, if you go to the casino and you lose $200, it's such a shitty ride home. Yeah. Imagine losing $100K, right? So, and there's guys, they lose millions and billions, right? But I lost that and I was so worried about it. But then I sold a property because I was buying another property and I had a huge gain. Dollar for dollar, I got it back. And I was like, oh, thank God.
There you go.
Thank God. So you got to play the game.
You do.
If you're in it, you got to play the game.
You do. You got to know when to sell, right? You can't have any feelings attached to properties.
There has to be an exit.
Yeah.
There has to be an exit somewhere. And if you don't exit it while you're living, then when you die, the CRA deems that a day before you died, that you disposed of your assets, and then your estate will get hit with a capital gains tax.
Especially if you don't have a will either.
Oh, then you're into probate and all kinds of things. Everything. But the point being is they're playing that game. Mm-hmm. You got to be playing the same game.
Of course.
There's got to be that, that mindset that I'm in this system and I got to play within it. Mm-hmm. Or don't play in it. Don't play in it, but you can't be 1 foot in, 1 foot out.
Give you the guidelines to follow, right?
Yeah.
So you got to know what rules play in your favor and what don't.
And it's funny because that one client that was complaining that their payments went up so much, and obviously I'm the bad guy, I'm in control of it. So, but they were mad at me, and I'm like, if it's really stressing you out this much, why don't you just cut your losses and go? You're already invested in other properties you're going to make money on. So why don't you just use that credit to then one day in the future offset it? And they said no. Yeah. Okay, so what are you mad about? Then stay in the situation you're in.
Yeah.
There's nothing to be mad about. It's just dollars and cents. It's just money. Figure it out. So yeah, I'm a long-term investor. I think people in the long run will benefit from owning real estate. I mean, just look at previous generations.
Of course.
So much equity in their homes. Not everyone's going to be a savvy investor where they rent where they live and they invest their funds and that way they make a greater return. Not everyone's going to be like that. Sometimes there's a reason why they say your home is a savings account. It's a liability because it takes money out of your pocket every month, but it's a savings account because it forces you to pay for it.
So there's this school of thought as well that you brought it up now is your home really a savings account? If you look at all the interest payments, let's say you're living in one house your whole life, pay off the mortgage after, I guess, 15, 20 years. After you consider the interest payments on it.
You're lucky if you break even, in my
Right.
opinion, when you look at the numbers. I've looked at those numbers
scary,
often.
right?
Yeah. So the only way that I think when that phrase makes sense, when people say it's a savings account, is that it forces you to have the money to pay for it.
Exactly.
But otherwise, it's completely a liability. And I think people are starting to realize that.
Yeah.
I think people are realizing like a liability is simply something that it takes money out of your pocket every single month. That's what a mortgage is. That's what a house does. If you own a rental property and it's bringing you cash flow and you're making money, then it's an asset.
Exactly.
Right. So I think people need to start looking at it that way.
For sure. And then I think right now it's a good opportunity with the new announcements with CMHC made on December 15th, where you're able to increase the purchase price for insured mortgages from 1 million to 1.5,
Yep.
right? And it gives you 30-year amortization. It might be a good look for some people to buy a combo owner-occupied rental property.
Like a duplex.
Right?
Now, is that policy for first-time home buyers only?
Which, the 1.5?
Yeah.
Not necessarily. First-time home buyers only is a 30-year amortization.
That's all they get?
30-year amortization and the 1.5 as well.
Yeah.
You don't need to be a first-time home buyer, just qualify to an insured mortgage for your primary residence.
No, but I mean, for those new rules, the 30-year amortization and the 1.5 cap, is it only applicable to first-time home buyers?
The 30-year am is only for first-time home buyers.
First time.
1.5 million is for anyone doing an insured mortgage.
Got it. Okay. Yeah. So why would that help somebody if they're not a first-time home buyer? They still get a 25-year mortgage, but it's insured.
It's insured. It has to be primary residence. You can't buy an investment property.
But why is that a benefit compared to where it was at now?
The price point. I guess you get more of a pool of inventory to look at versus
at better rates, because insured means you're going to get better rates.
too. Yeah, it'd be better rates too. But you also get the 30-year amortization, and then I guess from looking at condos, you can now look at maybe a semi in the city, right?
Right.
As long as you can afford it, of course.
But that's for a first-time home buyer, 30 years.
Yeah.
So what if you're not a first-time home buyer? Is there really that much of a benefit to it?
25-year amortization is only the purchase price.
It's more just the purchase price. But then that unlocks what for them? Insured rates?
Insured mortgages and rate. Like insured rates.
Oh, and not having to put 20% down.
Exactly.
Got it.
Because not everyone has the 20% down.
Got it.
But in my opinion, if you're going to go that high, you should look into putting 20% down because it's going to affect you financially. Like monthly wise, if you can't afford it, it's going to be tight. You're going to be house rich, cash poor.
I've never, ever not put less than 20.
Yeah.
Not because I don't want to. It's just I was never eligible. None of these programs I was ever eligible for.
Really?
Ever. It's such a weird thing. Like my first condo that I bought and I moved into it was 20% down. Yeah. I was like, I never got these benefits.
Yeah.
You know, I never got any CERB. Never got anything, man. The other stuff for business, never.
Pay your taxes on time, everything.
I always do my stuff on time. I'm a little late this year, but it's I'm just transparent about like I want to do it the right way.
Of course.
No
shortcuts.
No. And it's interesting, like if you're a first time home buyer, like that's something you could take advantage of right now.
Yeah.
You know? And off like a $900,000 mortgage, the difference between 25 years and 30 years at a rate of like 4% is like roughly
almost like
$500-600.
Yeah.
$400 or $500.
Exactly. On a 1 million is like $500 or something on a $1 million mortgage.
There you go.
Right. $500 payment difference. That's huge.
It's a car.
Yeah. It's a car payment right there.
It's a Civic.
Yep. SI maybe.
Maybe. But okay. So you're not seeing or hearing any rumblings at the bank where Are they like that's pessimistic? You're seeing more optimism? Is that what you're saying?
Optimism, we're seeing more positive forecasts coming out.
Okay.
Like even like rates wise, we're expected to see by end of 2025, the Bank of Canada prime rate to be around 2.75%. It's sitting at right now around 4.5.
That's what they think is going to happen?
Sorry, 4.25.
Okay. So if it's 2.75, what can people expect the variable rate is going to be that they're going to get?
The bank's prime rate will probably be around 4.75 at that point. Like I'm giving it a 2% pricing in between. So rates should be around, if you get like 0.8, should be around 3.5 almost.
As a variable?
As a variable.
Where do you think fixed is going to be at that time? Much lower?
In 2025, I'm hoping fixed rates are in like the mid threes to low threes. I'm basing this off of my previous experience prior to COVID. That's where the rates were sitting at. Like a 5-year fixed, you'd probably get it for like 3.2%,
Interesting.
3.3%. 3-year fixed, like 3.4%.
Okay. So what's your official prediction for our audience in terms of the real estate market? Are we going to see prices stable, stay the same, or go up or go down over the next 6 to 12 months?
Over the next 6 to 12 months, I don't think prices will go down. Because I think we already reached a peak where I think, correct me if I'm wrong, over the last 2 years, how much is prices adjust in GTA? Like 15%?
Yeah, I said that on another episode. There's some markets that hit close to 30, some 20, some 15. Like prices have come down quite a bit.
Yeah, so if it comes down more, I don't think it's going to go down to a point where everyone's expecting it to be a detached house in Toronto for like 800,000. I think we're far gone. We're past that point.
I don't disagree with you.
Yeah. So I think even if we do come down, maybe another 10%. Right? Maybe people will still sit on the sideline a little bit to see rates come down more drastic.
There's a lot more supply.
More supply. So I don't see it decreasing, but I do see prices increasing over the next bit.
All it takes...
It depends on the supply though, right?
It depends on the supply. Short term, it's going to depend on the supply.
Yeah.
Because there's a lot of mortgages coming up for renewal. People might want to get out. There's a lot of inventory that got delayed coming online now all at the same time. Things have to stabilize a little bit. But I think once that's done, if all else remains equal, that things are just going to skyrocket like it did before. Because there hasn't been really much like new projects come online. And we know it takes time to build here. So maybe it's not next year. Maybe it's not 2026. But I think in the years to come, like if you look at 2027, that means the project should have sold. If it's like a 4-year build, it should have sold in 2023-ish.
Exactly.
And they didn't launch and sell in 2023, really.
There's nothing happening in 2023.
Right? Or even in 2022, towards after the rates started going up, there weren't really many projects that got launched. It actually came to a standstill.
Yeah.
And so that brings us to 2026. So yeah, next year is going to be interesting. It might be a little bit volatile. We'll see.
It's going to be a lot of ups and downs.
Yeah.
Like I said in the beginning of the show, just got to put your seatbelt on and go for the ride, right?
That's right. We don't got seatbelts in here, but that's
okay.
Right. Kiri, this was great. Do you want to leave our audience with any last thoughts?
No. You put me on the spot.
You got to plug me in. Talk to Millennial's Choice, right? Guys,
Matt, tell me, what's your outlook?
I think that I think in the short term there could be price decreases a little bit, or we're right at the bottom. But I think the same amount of the decrease might be the same amount of the increase, one way or the other. There's a 10% decrease, there might be a 10% increase on the opposite side. Yeah. So that's what I'm thinking. I don't think things are going to skyrocket up through the roof. I don't think things are going to come crashing down. Like think about it. If you're the government and things crash like that, and like you're gonna have way bigger problems on your plate.
Of course,
it's just gonna be anarchy. Like, I don't think anyone wants that.
No.
That's kind of where my head goes.
You gotta date the rate and marry the house.
Yeah, marry the property for sure. That's what that's what I've heard. Date the rate.
Yeah.
Well, thanks again for coming on. We'll
Thank
put all
you
your
for
notes.
Me.
Yeah, of course. We'll put all of your information on our show notes.
Yep.
And you guys connect with Kiri, connect with myself. Thanks for staying to the very end. And until next time, we're out.